Thank you for viewing this presentation. My name is Brad Renard. I'm Chief Investment Officer of Monthly Cash Thru Options. And the objective of this presentation is to give you an overview of our firm. It's entitled Sophisticated Alternative Long-Short Strategies Not Typically Available to the Retail Investor. About Monthly Cash Thru Options. We're headquartered in San Diego, California. We're founded in 2005. We specialize in developing long-short hedged investment strategies that blend technical, fundamental, and quantitative analysis. We manage 5 investment strategies: small cap momentum, contrarian fund, directional alpha, sector rotation, and iron condor. MCTO leadership. My name is Brad Renard. I'm the Chief Investment Officer. I have 20 plus years of experience in stock and options trading. My personal interest is in developing blended strategies that leverage technical, fundamental, and factor-based quantitative analysis. I was in high tech for 20 years in Silicon Valley, working for myriad technology companies in engineering, marketing, and then sales. My education is I have a BS in physics, a BS in electrical engineering from Columbia University, and an MBA from the University of Chicago Booth School of Business. So what drives us to develop blended strategies? The University of Chicago is home to 89 Nobel laureates, and the Booth School of Business has several professors classified as the founding fathers of investment theory. So I was at Chicago in the early 90s, and so while at Booth, I had many lively debates with professors such as Eugene Fama, a Nobel recipient, and Kenneth French about how to beat the market. Their research showed that it was nearly impossible to beat the market from efficient market theory. That is, all information is already embedded into all stocks within the market. However, Fama and French and other academics during the early 90s never could fully explain or model the concept of momentum. And that's where I got my interest in augmenting robust analysis, such as macro and micro fundamental analysis, with technical and quantitative analysis. And those tap into momentum. And thus, that's what drives many of our strategies. So we blend technical, fundamental, quantitative, and hedging in the portfolio. So here's our process. The first thing we do is macro market timing. And macro market timing is big picture analysis of the market, and it drives allocation decisions of what percentage of our trade should be long, what percent should be short, and overall exposure level. Should we be 100% allocated, 50% allocated, maybe 0% allocated for a week or 2 or 3? Then at the stock or micro level analysis, we do technical, fundamental, and quantitative analysis. And this provides our entry and exit triggers for individual trades. Overall, this increases the probabilities of opening winning trades while reducing volatility in the portfolio. So let's look at macro market timing. And again, this drives allocation levels, big picture of what percentage should be long versus short, and overall exposure levels of our portfolios. Macro market timing. Technical analysis at the macro level focuses on charts of the major indices such as the S&P 500, that's the big caps, S&P 400, those are the mid caps, S&P 600 small caps, those are indexes, and the NASDAQ 100 tech stock index and the NASDAQ composite index, along with indicators. And what we're looking at within those charts are support and resistance, trend lines, moving averages, big picture indicators such as unbalanced volume and McClellan summation index. That's just an example. Also, we're usually monitoring the weekly charts for the big picture insight into the health of the market. So, of course, we're watching the daily charts, but weekly charts are really important for the macro market timing analysis. And here's an example. What I show here is the 1743 weekly EMA, exponential moving average, on the NASDAQ Composite Index weekly chart. So again, this is the NASDAQ Composite. This has about 2,500 stocks in it. Each bar of this candlestick chart represents 1 week of trade. It goes from 2018 all the way back to 1999. We show the 17-week exponential moving average in blue, and we show the 43-week exponential average in black. And this is just one of many charts that we look at least on the technical level, for big picture. And the big picture tells me if the 17 is above the 43, that means we're in a long-term confirmed uptrend. And then when the 17 crosses below the 43, we are now in a long-term confirmed downtrend. And for traders like us, we will start over-allocating on the bearish trades during the bearish times. And these vertical lines represent crossovers. So that's a bearish crossover, that's a bullish crossover. Here in January 2008 was a bearish crossover. Here in about June 2009 was a bullish crossover. So you can see from 2009 all the way to 2016, we were in a long-term confirmed uptrend. I think there was one time here where we would have been stopped out, thrown out of the trades. We would have been very, very cautious at this point of opening and adding too much exposure when the 17 starts going below the 43. Then in 2016, we had a bullish cross, and this was when Trump was elected president. And then you can see that we've been in a long-term confirmed uptrend since the Trump election. Okay, so that's just an example of macro market analysis using technicals. Okay, let's look at other things that we look at for macro market timing. One is economic data. Monthly employment report, initial unemployment claims, consumer credit, retail sales, ISM index, factory orders, inflation numbers, gross domestic product. And here are some of the charts that represent this economic data. Interest rates, so the 10-year Treasury, and the yield curve. That's the difference between the rate on the 2-year note and the 10-year note. And we have a few charts that we watch. Corporate earnings growth. That's very important, and that's what ultimately drives stock prices. And of course, we have a chart for that. Corporate debt markets. We care very much about that. Companies are constantly issuing debt, and sometimes if we have issues and stress in the debt markets, it will ultimately impact the stock market. Strength of the US dollar. We show a chart that comes up there. Federal Reserve, what their posture is and how fast they're raising rates. Market sentiment. Now this can include many things, including breadth charts, number of stocks, for example, above the 50-day SMA for most of the indexes. We want to watch the major indexes in this. Advanced decline line, seasonality, sector rotation, overbought, oversold indicators, and you can see lots of charts represent each one of those. We care about outside influences. China, Japan, Germany, France, UK, Italy. What do their charts look like? How well are they doing? Because they can ultimately impact us. Also geopolitical. And we have lots of charts that represent those. So this kind of wraps up what we look at for macro market timing. So back to macro market timing. That drives our big picture allocation levels of long, short trades, what should be long, what should be short, and overall exposure levels of all the portfolios. Next is the micro level analysis at the stock level. This is where we do the technical, fundamental, and quantitative analysis. And this provides entry and exit triggers for individual trades. So at the technical analysis at the stock level or micro level, I show an example here of Google, typical chart. I show the 200 days simple moving average here, 50-day EMA exponential moving average. Here's the 13-day exponential moving average. This is a Google daily chart. These are candlesticks. Each one represents 1 day of trade. I show two indicators here, a 535 oscillator, and I show a commodity channel index, CCI indicator. So technical analysis at the micro level focuses on the charts of the stocks or the ETFs that we're trading, along with indicators. Indicators are the candlesticks, support and resistance, trend lines, moving averages, and indicators such as the 535 and the CCI that's shown. Technical analysis helps us identify high probability bullish and bearish trade setups. All MCTO portfolio managers are experienced chart technicians. Okay, at the stock level and the micro level, we have fundamental analysis. We just looked at technical analysis. We also care about fundamental analysis. Basically, how healthy is the stock or that company? So at the stock level, we use specialized software to screen stocks to identify the companies with the following. We're looking for strong revenue growth, strong earnings growth, strong cash flow generation and growth, looking for stocks in the upper percentile for return on equity metrics, among others. For bearish hedge trades, we screen for the opposite. Weak revenue growth, weak earnings growth, deteriorating cash flow generation, among others. All MCTO portfolio managers are experienced in performing fundamental stock analysis. And then the third thing we look at the stock level or the micro level is quantitative analysis. The definition of quantitative analysis is the use of econometric statistical mathematics to provide predictions such as probability that a stock will break up or down through a particular level, and probability that a stock will move a particular magnitude up or down once it breaks through a level. In order to do quantitative analysis, this requires several years of education in econometric mathematics and statistics, along with 2 or more years of experience in developing and optimizing models that offer predictive significance. So what we just showed is what we call our 4-level scanner. And here's a summary of it. So at the macro level, that's macro market timing, this drives big picture allocation and exposure levels for our products. At the micro level, this is where we do our technical, fundamental, and factor-based quantitative analysis. So at the technical level, we're identifying stocks that have moved into high probability technical setups, and we watch support, resistance, moving averages, relative strength, for example. Then on the fundamental level, we're identifying stocks that have strong fundamentals, good sales growth, earnings growth, pre-tax profit growth, return on equity. And then at the micro level, for the quantitative analysis, we're identifying stocks through factor-based quantitative analysis that exhibit high probability of making a move up or down and have high probability that the magnitude of the move will be significant. Finally, we allocate a portion of the portfolio of each product to short hedge trades. And that reduces volatility of the portfolio while boosting returns and offers protection during market corrections or black swan events. So this summarizes our methodology, our 4-level scanner. The MCTO strategies. We have directional alpha. This is a long-short strategy that extracts maximum gain from a directional move in a short period of time. And this one buys calls and puts on the bullish and bearish trades. Small cap momentum. This one buys stocks with strong momentum with a market cap of 250 million to 5 billion. So we're buying the stocks for the bullish trades and we're buying puts for the bearish trades. Contrarian. We buy stocks that have been out of favor for 6 to 12 months and are starting to recover. Sector rotation. We buy strong stocks within strong industry sectors. Money is constantly rotating from sector to sector to sector, and we follow the money. Iron Condor. This is a non-directional, income-generating, option-selling strategy that opens 2 week in duration, 85 to 90% probability, index credit spreads and iron condors, using weekly options on the S&P 500 index, the SPX. Also, we'll periodically use the Russell 2000 index, that's the RUT, R-U-T. For the first 4 strategies above, they leverage the 4-level scanner, comprising technical, fundamental, and factor-based quantitative analysis, and they also allocate a portion of the portfolio to short hedge trades. Our newsletters, we have the MCTO letter. This performs technical, sentiment, and macroeconomic market analysis. It can help investors and traders better time their entries and exits, regardless of their preferred strategies. And that's delivered via email every Sunday evening. We have the Trade of the Day newsletter, TOTD. And this basically selects 3 trades weekly from the directional alpha strategy. And is targeted to the self-managed client. And for my last slide of this presentation, I'd like to make a few comments about passive versus active investments. During the 2008 and 9 crash and recession, many investors lost 40 to 60% of their money. What we saw is that markets go up and markets go down. And when markets trend up, they trend up usually gradually and slowly. And then when they drop quickly. When buying the market, for example, buying a major index or an ETF that tracks an index, it will historically return 7 to 9% annually. Indexes have all stocks in them, good and bad, so the returns are average. Passive investments in indexes have had abnormally high returns since the Trump presidential win. And looking at the chart that we've seen several times already in this presentation, this is the NASDAQ composite. This is a weekly chart. This is 1999 through 2018. We can see during the presidential election, when Trump won, the market started climbing higher in anticipation of pro-business initiatives, corporate tax cuts, deregulation. Corporate earnings are growing, but 20% growth rates are not sustainable. And markets are now expensive, priced for perfection at 17.5 times forward earnings. So we need to be careful with this market as of September 2018. First thing that jumps out at me when I look at this chart is how steep this is right here. And you can compare it to what happened at the very end of the big bull run of the 1990s, where we had a blow-off top where it just went straight up. And then we know what happened after that. This is the dot-com crash right here, where this market was cut about 60% in value. So this is pretty steep. So we need to be careful with this market. So active managers can navigate an expensive market that is priced for perfection, like what we have today. So we buy individual stocks with strong momentum We can make above average returns with these because we're buying the best stocks, usually in the strongest sectors. We also open bearish trades for hedges. Thus, we're being nimble. Most of our trades are pretty short term, usually in the 5 to 30-day range, and we exit positions quickly based on strict exit rules. So, based on the steepness of the chart, which is not sustainable, and how 20% quarter over quarter earnings growth is also not sustainable, along with an expensive market that is priced for perfection, this might be the time to take a hard look at your portfolio to see how much is currently allocated to passive ETFs or indexes. If you're like most busy professionals who only look at their accounts once a month, and if you find that you have allocated most of your assets to passive ETFs, it might be time to consider to start incrementally reallocating some money out of passive investments and into actively managed long-short strategies. Just food for thought. So that wraps up the presentation. Here are our disclosures, and thank you. If you'd like more information about monthly cash through options, please visit our website at monthlycashthroughoptions.com. That's through is THRU. Or you can email us at support@monthlycashthroughoptions.com or call us toll free at 877-248-7455. We also have free 30-day trials and $5 specials for the first month for most of our products. Thank you very much for your time, and please contact us if you have any questions.